Right then, picture this mental scene. It's July 2025, and Andrew Dudum, the bloke who built a $14 billion empire by selling little blue pills on Instagram, is staring at legal papers that could destroy everything he's created. Novo Nordisk, one of the biggest pharmaceutical giants on the planet, has just terminated their partnership and slapped him with a lawsuit, claiming his company is peddling illegitimate knockoff weight loss drugs. The irony is absolutely brilliant. A company that made its fortune solving people's most embarrassing health problems is now facing the most humiliating moment in its corporate history. This is the story of Hims & Hers Health, the telehealth startup that discovered something rather extraordinary. Embarrassment is worth billions. What started as 3 entrepreneurs selling erectile dysfunction treatments from above a hair salon has become a $14 billion juggernaut that's got Big Pharma so rattled they're fighting back with everything they've got. We're talking about a company that generates over $1.5 billion in revenue by helping people avoid those awkward conversations with their doctors, the sort of business model that could only work in America, where they've somehow managed to monetize shame itself. Whilst we Brits are still queuing politely for months to see our GPs about the most basic ailments, assuming we can even get an appointment before we die of old age, these Silicon Valley lads figured out how to turn social stigma into subscription revenue. They built an empire on the simple premise that people would rather order prescription medications, like they're buying sneakers on Amazon, than sit in a waiting room full of judgmental strangers. The numbers are absolutely staggering. From 82 million in revenue back in 2019 to nearly 2 billion today. That's a 1,688% increase in just 5 years. 800,000 people signed up for their weight loss program alone, desperate enough to try anything that doesn't involve admitting to their doctor that they can't fit into their trousers anymore. But now the very success that made Andrew Dudum a billionaire is threatening to bring the whole thing crashing down, with multiple class action lawsuits claiming the company misled investors about regulatory compliance, whilst Big Pharma circles like vultures. You'll want to stick around for this tale, because it's got everything. A Wharton grad who turned awkward doctor visits into $1 billion subscription service, pharmaceutical giants losing their minds over startup competition, and enough legal drama to make your head spin. This is the story of how 3 blokes discovered that what people are most ashamed to talk about might just be the most profitable business opportunity in healthcare. To understand how Hims became worth $14 billion, you need to grasp something that traditional healthcare completely missed. People will pay premium prices to avoid embarrassment. Not just a bit extra. We're talking about customers who gladly fork over subscription fees month after month, rather than have one awkward conversation with their GP about their dodgy bits not working properly. Hims & Hers operates as what they call a front door to the healthcare system. But that's corporate speak for, we'll sell you prescription drugs without making you sit in a waiting room next to your neighbor's mum. The company has built a telehealth platform that connects customers directly with licensed healthcare providers through apps and websites, focusing specifically on conditions that make people squirm: erectile dysfunction, hair loss, anxiety, weight problems, and skincare issues that make you want to hide under a rock. The genius of their business model is subscription-based recurring revenue. Instead of one-time purchases, customers sign up for monthly deliveries of medications. Erectile dysfunction treatments start at just $3 per dose. But when someone's taking those regularly, you're looking at nearly $100 per month. Multiply that by millions of subscribers across multiple embarrassing conditions, and suddenly you understand how they hit nearly $2 billion in annual revenue. Unlike traditional healthcare, where you might see a doctor once and get a prescription filled at a pharmacy, Hims owns the entire customer experience. They handle the consultation, prescribe the medication, manufacture or source the drugs, ship them directly to your door, and provide ongoing customer support through messaging. It's like Amazon Prime for your most mortifying health problems, The sort of vertical integration that would make Jeff Bezos weep with envy. The company serves customers in the United States and United Kingdom, though their expansion internationally has been slower than molasses in January. They've positioned themselves as the anti-establishment healthcare option, bypassing insurance companies, eliminating doctor office visits, and making prescription medications as convenient as ordering takeaway. The result is a customer base that includes over 73% of users who actually prefer HIMSS over traditional healthcare providers, which tells you everything you need to know about how rubbish the traditional system must be. What makes this even more brilliant is that they're not just treating embarrassing conditions, they're treating conditions that traditional healthcare has largely ignored or handled poorly. Men with erectile dysfunction often wait years before seeking help. People with hair loss spend fortunes on useless treatments. Anxiety sufferers avoid therapy because of stigma. HIMSS identified these massive underserved markets and built an entire business around solving problems that established healthcare pretends don't exist. The story begins in 2017 with Andrew Dudum, a serial entrepreneur who'd already built and sold companies before he was 30. After graduating from Wharton, one of those posh American business schools that produces more venture capitalists than actual useful human beings, Dudum had founded Atomic Labs, a startup studio that launched multiple companies. He'd successfully exited from TalkBox, a voice messaging app, and was busy being an angel investor and advisor when he noticed something that would change his life forever. Dudum realized that millions of men were suffering in silence with erectile dysfunction, hair loss, and other embarrassing conditions because the traditional healthcare system made seeking help absolutely miserable. Think about it. You have to call your doctor's office, explain your problem to some receptionist who probably knows your wife, wait weeks for an appointment, sit in a waiting room full of people, then have an awkward conversation with a doctor who might judge you for letting things get this bad. The eureka moment came when Dudum understood that this wasn't just inconvenient, it was a massive market opportunity. Generic medications for erectile dysfunction cost pennies to manufacture, but were being sold at ridiculous markups through traditional channels. Meanwhile, millions of potential customers were avoiding treatment entirely because the process was so bloody awful. Dudum partnered with co-founders Hilary Coles, Jack Abraham, and Joe Spector to launch what would initially be called just HIMSS, focusing exclusively on men's health. They raised $7 million in seed funding and made a crucial decision that would define their entire strategy. They would start with erectile dysfunction, the most stigmatized condition they could find, because if they could make that work, everything else would be easy by comparison. The vision was inspired by companies like Warby Parker, which had disrupted eyewear by selling directly to consumers online. But instead of selling glasses, they would sell dignity. Instead of disrupting fashion, they would disrupt shame. The plan was audaciously simple. Take embarrassing health conditions, remove all the barriers that prevent people from seeking treatment, and charge subscription fees for the privilege. Within months, they had built a platform that could connect users with licensed healthcare providers for virtual consultations, prescribe appropriate medications, and ship treatments directly to customers' homes. The entire process could be completed in under 20 minutes without ever leaving your house or speaking to another human being out loud. For men who had been suffering in silence for years, this was nothing short of revolutionary. But starting with erectile dysfunction was also incredibly risky. Traditional healthcare companies, pharmaceutical giants, and medical regulators all had established ways of doing things. Dudum and his team were essentially declaring war on an entire industry that generated hundreds of billions in revenue by making healthcare complicated, expensive, and embarrassing. They were David taking on multiple Goliaths, armed with nothing but a website and some very uncomfortable advertising campaigns. By 2018, Hims faced the challenge that kills most healthcare startups. How do you advertise prescription medications for embarrassing conditions without getting laughed out of the room or shut down by regulators? Traditional pharmaceutical companies spend billions on advertising, but they focus on vague messaging about talking to your doctor rather than actually solving customer problems. Hims decided to take a completely different approach that would shock the entire industry. They launched advertising campaigns that were bold, direct, and absolutely mental by pharmaceutical standards. Instead of showing happy couples walking on beaches while listing 17 potential side effects, Hims put up billboards in major cities with messages like "hard made easy" and started running Instagram ads that actually showed their products. They treated erectile dysfunction medications like any other consumer product, complete with sleek packaging and straightforward messaging. The response was explosive. Within months, they were generating millions in revenue and attracting customers who had never even considered seeking treatment through traditional channels. But success brought its own problems. They were processing orders faster than they could fulfill them. Customer service was overwhelmed, and competitors were starting to take notice. The brilliant move came when they expanded to Hers for women's health, covering everything from birth control to anxiety medications to custom skincare. This wasn't just about doubling their market. It was about positioning themselves as the go-to solution for any health condition that people found embarrassing or difficult to discuss. They raised $97 million in venture capital and began scaling operations to meet exploding demand. What made their marketing strategy particularly clever was understanding that social media algorithms actually work in favor of health-related content. People researching erectile dysfunction or hair loss treatments online create very specific digital footprints, making them easy to target with relevant advertising. Unlike traditional pharmaceutical companies that rely on broad television campaigns, Hims could precisely target potential customers who were already actively searching for solutions. But the real innovation was making prescription medications feel like lifestyle products. Instead of medical packaging that screamed, "You have a problem," Hims designed sleek, minimalist packaging that looked more like premium skincare or supplements. They branded themselves as a lifestyle company that happened to sell medications rather than a pharmaceutical company trying to be cool. The marketing revolution extended beyond advertising to customer experience. Traditional pharmacies make you wait in line, deal with insurance hassles, and pick up medications from behind a counter, like you're buying something illegal. Hims delivered everything directly to your door in discreet packaging, with customer support available through messaging rather than phone calls. They had essentially reinvented pharmaceutical retail for the smartphone generation. By 2019, they were generating over $80 million in revenue and had attracted millions of customers who preferred their approach to traditional healthcare. The company had proven that embarrassing health conditions represented a massive, underserved market and that consumers would pay premium prices for convenience, privacy, and dignity. But their biggest challenges were still ahead. The year 2020 changed everything for telehealth companies, and Hims was perfectly positioned to benefit from the chaos. When COVID-19 forced people to avoid doctors' offices and traditional healthcare settings, suddenly everyone wanted virtual consultations and home delivery of medications. Hims rebranded to Hims and Hers Health to reflect their broader focus beyond just embarrassing conditions. They expanded into mental health treatments for anxiety and depression, added comprehensive skincare services, and began positioning themselves as a full-service telehealth platform rather than just a direct-to-consumer medication company. The timing couldn't have been better. Venture capital was flowing into anything related to digital health, and consumers were finally ready to embrace virtual healthcare. The company went public in 2021 through a SPAC merger, which is basically a way to go public without all the traditional regulatory scrutiny and roadshow presentations. The initial valuation was $1.6 billion, making Andrew Dudum and his co-founders incredibly wealthy on paper. But going public also meant exposing themselves to the volatility and scrutiny of public markets, where quarterly earnings reports matter more than long-term vision. The SPAC boom was perfect for companies like Hims that had explosive growth but questionable profitability. Traditional IPO processes require companies to demonstrate consistent earnings and clear paths to profitability. SPACs allowed growth-focused companies to access public markets based on future potential rather than current financial performance. For a company built on subscription revenue from embarrassing health conditions, this was absolutely crucial. But public market success brought new pressures and opportunities. Wall Street analysts wanted to understand how Hims could expand beyond their core markets, what their long-term competitive advantages were, and whether their subscription model was sustainable. Meanwhile, competitors were raising massive funding rounds to challenge Hims in their core markets, and traditional healthcare companies were finally starting to take telehealth seriously. The pandemic created unprecedented demand for Hims services, but it also accelerated competition. Companies like Roman focused on men's health, Nurx, women's health, and Lemon Health, general telehealth, were all raising hundreds of millions to challenge different parts of Hims' market. Even worse, tech giants like Amazon were launching their own telehealth services with virtually unlimited resources and existing customer relationships. During this period, Hims made crucial strategic decisions that would define their future. They invested heavily in expanding their clinical team, building out their technology platform, and acquiring customers across new therapeutic areas. The subscription model that had worked brilliantly for erectile dysfunction and hair loss was being tested across anxiety medications, birth control, skin care, and eventually chronic conditions like heart health. The results were mixed but promising. Customer acquisition costs remained reasonable, retention rates were strong, and revenue growth was explosive. But profitability remained elusive, and the company was burning through cash to fund expansion. The question facing investors was whether Hims could build a sustainable, profitable business, or whether they were just another venture capital-funded growth story that would eventually crash when the funding dried up. By 2023, Hims faced a mature market problem that plagues every successful startup. Their core business was growing, but not fast enough to justify their public market valuation. Erectile dysfunction and hair loss treatments had limited market sizes, and competition was intensifying. The company needed a new category that could deliver massive growth, and they found it in the most unexpected place: weight loss medications. The breakthrough came when pharmaceutical companies like Novo Nordisk launched GLP-1 medications like Ozempic and Wegovy for weight management. These drugs were revolutionary. They actually worked for weight loss, helping people lose significant amounts of weight with relatively manageable side effects. But they were also incredibly expensive, often costing over $1,000 per month, and insurance coverage was limited. Most importantly for Hims, there was massive stigma around using medication for weight loss. Hims saw the opportunity immediately. Millions of people wanted access to effective weight loss medications, but couldn't afford brand-name drugs or didn't want to discuss their weight problems with traditional healthcare providers. The company launched a weight loss program using compounded versions of GLP-1 medications, essentially generic alternatives that provided similar benefits at much lower costs. The results were absolutely mental. Within months, over 800,000 people had signed up for Hims' weight loss program, generating hundreds of millions in new revenue. Users were achieving average weight losses of 10.5 to 12.2% of their body weight, with dropout rates significantly lower than traditional weight loss programs. The company had found another massive underserved market where embarrassment and traditional healthcare failures created enormous opportunity. But weight loss medications also transformed Hims' financial profile. Instead of charging $30 to $100 per month for erectile dysfunction or hair loss treatments, they could charge several $100s monthly for weight loss programs. The increased revenue per customer dramatically improved their unit economics and path to profitability. For the first time since going public, Hims was generating enough cash flow to fund growth without constantly raising additional capital. The weight loss expansion also validated Hims' core thesis about embarrassing health conditions. Despite decades of diet and exercise advice, obesity rates continued climbing because traditional approaches didn't work for most people. Weight loss medications provided a medical solution to a medical problem, but the stigma around using drugs for weight management kept millions of potential patients from seeking treatment. Hims removed that barrier by making the entire process private, convenient, and judgment-free. Competition in weight loss was fierce, with companies like Roe, Calibrate, and Found all launching similar programs. But Hims had advantages: an existing customer base, proven operational capabilities, and a brand already associated with solving embarrassing health problems. They could cross-sell weight loss services to existing customers and leverage their marketing expertise to acquire new users. The expansion into weight loss also demonstrated Hims' potential for future growth. If they could successfully expand from erectile dysfunction to weight management, what other large, underserved markets could they address? Diabetes management, mental health, hormone therapy, fertility treatments. The possibilities were enormous for a company that specialized in making healthcare more accessible and less embarrassing. The massive success of Hims' weight loss program inevitably attracted attention from pharmaceutical giants who weren't thrilled about losing market share to a Silicon Valley startup. Novo Nordisk, the Danish company behind Ozempic and Wegovy, watched their expensive brand-name medications being undercut by compounded alternatives sold through slick direct-to-consumer marketing campaigns. Their response was swift and brutal. In July 2025, Novo Nordisk terminated their partnership with Hims and filed a lawsuit claiming the company was promoting illegitimate knockoff versions of their medications through deceptive promotion. The lawsuit triggered multiple class action cases from investors claiming securities fraud, arguing that Hims had misled shareholders about regulatory compliance risks. Suddenly, the company that had built its reputation on solving embarrassing problems faced its own very public embarrassment. The legal battles revealed the fundamental tension between innovation and regulation in healthcare. Hims argued they were providing affordable access to life-changing medications that were otherwise out of reach for most patients. Pharmaceutical companies countered that compounded medications weren't subject to the same safety and efficacy standards as FDA-approved drugs, potentially putting patients at risk while undermining incentives for research and development. But the lawsuit also highlighted just how threatening Hims had become to traditional pharmaceutical business models. When a startup can offer similar therapeutic outcomes at a fraction of the cost with superior customer experience, it exposes how much traditional healthcare companies rely on regulatory barriers and market inefficiencies to maintain their profits. Big Pharma wasn't just fighting Hims, they were fighting the entire direct-to-consumer healthcare revolution. The competitive landscape facing Hims is absolutely massive and constantly evolving. Traditional competitors include Roman, now Ro, which focuses on men's health and has expanded into similar therapeutic areas. There's Nurx for women's health, Lemon Health for general telehealth, and dozens of specialized companies targeting specific conditions. Each competitor is trying to build their own version of Hims' subscription-based direct-to-consumer model. But the real threat comes from tech giants with virtually unlimited resources. Amazon has launched Amazon Clinic for telehealth services and Amazon Pharmacy for prescription fulfillment. They have existing customer relationships, massive logistical capabilities, and the financial resources to operate at losses indefinitely while building market share. Google has healthcare initiatives, Apple is expanding health services, and Microsoft is investing heavily in healthcare technology. Traditional healthcare companies are also fighting back. CVS Health has Minute Clinic and is expanding telehealth services. Walgreens is launching digital health initiatives. Even traditional pharmaceutical companies are developing direct-to-consumer strategies to bypass traditional healthcare channels. The entire industry is being forced to adapt to consumer expectations that Hims helped create. The regulatory environment remains the biggest wild card. Healthcare is one of the most heavily regulated industries, and companies like Hims operate in gray areas that could be restricted or clarified at any time. Changes in FDA policies around compounded medications, telehealth prescribing rules, or advertising regulations could dramatically impact their business model. State-level regulations also vary significantly, creating compliance challenges for national expansion. Despite the legal drama and competitive pressures, Hims sits at the center of several massive trends that could drive growth for decades. The telehealth market is projected to exceed $100 billion globally, and consumer expectations for healthcare convenience will never return to pre-pandemic norms. More importantly, Hims has proven that embarrassing health conditions represent enormous underserved markets that traditional healthcare has largely ignored. The expansion opportunities are genuinely exciting to contemplate. Fertility treatments represent a massive market where couples often struggle with embarrassment, high costs, and limited access to specialists. Hormone replacement therapy for aging populations is growing rapidly, but remains stigmatized and difficult to access. Mental health treatments beyond basic anxiety and depression medications could address conditions like ADHD, sleep disorders, and social anxiety that people often suffer with in silence. Sexual health represents perhaps the biggest expansion opportunity. Beyond erectile dysfunction, there are massive markets for women's sexual wellness, LGBTQ+ health services, and sexual dysfunction treatments that traditional healthcare handles poorly or not at all. Hims could become the go-to platform for any sexual health concern, leveraging their existing brand recognition and operational capabilities. The company is also well-positioned to expand into chronic disease management, where traditional healthcare fails spectacularly. Diabetes management, high blood pressure, cholesterol treatment, and other chronic conditions require ongoing medication adherence and lifestyle support that could benefit enormously from Hims' subscription model and customer engagement approach. The key is identifying conditions where embarrassment, inconvenience, or traditional healthcare failures create opportunities for disruption. International expansion represents another massive opportunity, though it comes with significant regulatory and cultural challenges. The UK market alone could be enormous, given the challenges with NHS access and waiting times. European markets, Australia, and eventually developing countries could provide growth opportunities for decades if Hims can navigate different regulatory environments and cultural attitudes toward healthcare. The technology infrastructure that Hims has built could also support entirely new business models. They could license their telehealth platform to other companies, provide fulfillment services for other direct-to-consumer health brands, or expand into health insurance or wellness services. The customer data and relationships they've built represent valuable assets that could be monetized in ways that haven't been fully explored yet. Perhaps most intriguingly, Hims could expand into preventive healthcare and wellness services that aren't embarrassing, but benefit from their convenient, subscription-based model. Vitamin subscriptions, health coaching, fitness programs, nutrition planning. There are dozens of wellness categories where consumers want personalized, convenient solutions that traditional healthcare doesn't provide effectively. The financial projections are staggering if even a fraction of these opportunities work out. Analysts project potential revenues of $6 billion by 2030 if the company can successfully expand beyond their core markets while maintaining their competitive advantages. That would represent a continuation of their historical growth rates and justify current valuations even after the legal challenges. So there we have it, the absolutely mental story of how 3 Silicon Valley entrepreneurs discovered that embarrassment might be the most valuable, untapped resource in modern healthcare. From selling little blue pills on Instagram to building a $14 billion empire, Hims & Hers has proven that when traditional healthcare fails to serve basic human needs, there's enormous opportunity for companies willing to solve problems that everyone else pretends don't exist. The genius of Andrew Dudum's vision wasn't just identifying underserved markets. It was understanding that shame itself was a market barrier that could be disrupted with technology, marketing, and customer experience. By making embarrassing healthcare problems as convenient to solve as ordering takeaway, they tapped into demand that traditional healthcare had been ignoring for decades. Whether Hims can survive the current legal challenges and competitive pressures remains to be seen, but they've already fundamentally changed healthcare expectations for millions of consumers. The direct-to-consumer, subscription-based model they pioneered is being copied across the industry, and the stigma around discussing embarrassing health conditions has been permanently reduced. The real test will be whether they can expand beyond their core markets without losing the advantages that made them successful in the first place. Scaling from embarrassing conditions to general healthcare is a massive challenge that has defeated many companies, but Hims has proven they understand consumer psychology and market dynamics better than most of their competitors. For investors, Hims represents both enormous opportunity and significant risk, rather like most Silicon Valley companies that challenge established industries. The potential returns are massive if they can execute their expansion plans, but regulatory changes or competitive pressures could dramatically impact their business model at any time. What's certain is that Hims has identified something fundamental about modern healthcare. When you remove embarrassment, inconvenience, and judgment from medical care, enormous numbers of people will pay premium prices for solutions they desperately need. That insight alone makes their story worth understanding, regardless of what happens to their stock price. Right. Well, that's the tale of how erectile dysfunction became a $14 billion business opportunity, whilst the rest of us are still waiting 6 months to see our GPs about a dodgy knee. You'll want to stick around for more stories of Silicon Valley companies that discovered massive markets hiding in plain sight. Subscribe, and I'll keep digging into these absolutely brilliant business disasters.